Welcome to the October video of the Beginner's Guide to Algo Trading using PineScript. Today we're going to look at one of the most famous and well-known quantitative effects in the US equities market. Almost every quant is aware of this effect, and since this is a beginner's series to quantitative trading, it's important for you to know this effect as well. So I'm not going to cover this slide in too much detail. I have a previous video in the series about market edges. Definitely take a look at that if you're interested. And if you don't really understand what I mean by two different kinds of edge in markets, then you absolutely need to watch that video because you probably think edge only exists in certain ways, or that all strategies degrade over time, or just some other claim that has been thrown out there that isn't necessarily true. So what we're talking about today is even days. It's a statistical bias effect that exists in the market. And then we're going to use data mining to see if we can craft a strategy based on that bias effect. So this is the even days result. It is what happens if you were to buy the close of every odd day and then sell the close of every even day, essentially capturing the even days movement. And what you'll see is that for the first 2 decades of SPY, so from 1993 to 2013, you have essentially random movement. And for most markets out there, like if you trade commodities, this is what you're going to see. You're going to see what looks like random movement. And again, I'm talking only about the 1993-2013 range, which is about half of this result that you see here. And so a lot of the time for these other markets, the even days test yields just random behavior, and the odd days test just yields random behavior. But for SPY, what we've seen is that since 2013, there's been a bullish bias in the even days. And I'll show the odd days in the next slide, but you'll see that it doesn't hold up for the odd days. So here you see that there's a bullish bias for even days in SPY, but it's still not tradable just by itself. You've got the 2025 tariff scare, which led to that huge dip there. You've got the 2022 bear market, the COVID crash. You've got the crash a little bit before 2019. You've got a prior market or prior bear market in 2015. There's just plenty of huge dips in here that prevent you from just trading every, or just buying the close of every odd day and selling the close of every even day. However, this is usually a good place to start when trying to develop a strategy because it's measurable. So let's say that the strategy we develop based on this starts to perform poorly. Well, what we can do is we can look at this effect and say, is this effect still present, or is this effect itself degrading? Because our strategy that's using this as the basis of the effect, by having this as the foundation, we can analyze the degradation of that strategy's performance and say, okay, the strategy is performing poorly because this effect that it's based on is getting weaker. And so that is a good way for us, at least for the particular strategy we're going to develop today, to know that the effect doesn't work. And when I say that we're going to develop today, it's more like the strategy I'm going to show you today that was data mined in the past. Really, all I've done is I've taken the data mining results from the past, I've updated them up to the present day. But for the past 2 years, I have been trading the strategy based on this effect to pretty good success. So let's go look at the odd days. Again, the odd days is based on if you were to buy the close of every even day, hold through all of the movement of the following day, which would be odd, and then you sell the close. So this is what it looks like. It's pretty random. This is what most markets are going to look like outside of US equities. And if you were to test this on another market and you see something like this for both the odd days and even days, then I would just move on. I wouldn't try to look into this too much. And again, please don't look too deeply into this. You can look at 2013 and try to glean some sort of bearish behavior, but you're just going to get killed from these massive bullish upswings that you see in this chart here. And so I would just discount the odd days and just get straight to saying, look, we have an effect for the even days. Let's see if we can data mine something to produce a strategy that fits within our parameters that we want to see. And so I've talked about this in the past. If you're going to data mine, the wrong way to do it is actually to do what they market the data mining software as. So Build Alpha, Strategy Quant, Genetic System Builder, they're often telling you that you can just turn on the software, turn on all the filters for entry, all the conditions for exit, and let it just mine and come up with strategies for you. But most of those are not going to hold up if you were to trade them live. And I'll talk about that a little bit later in this video as I show some of the robustness testing that I do. But essentially, what we want to do to actually build a tradable strategy is first find some sort of bias or some sort of effect that already exists, and then use data mining to come up with a strategy that fits our parameters, rather than using data mining solely to try to come up with a strategy from mining every possibility in the universe. So what I've used here is I've set the strategy type to long only. It's on the SPY daily chart. And then the only parameters that I've set are, besides what you see on the left, which are like 50,000 initial capital, some amount of slippage, some amount of commission. The main one here is that there's a max hold time I've set of 10 bars, which is 10 trading days. That's basically half a month if you think about it. 5 trading days in a week, so 10 trading days is 2 weeks. We don't want to hold longer than 2 weeks or half a month, because at that point we're starting to become less of a trading strategy and more of an investment strategy. And of course, we're going to backtest from 2007 to 2019, even though the effect technically exists from 2013 to 2019, and that's just to see if the rules that it comes up with, by essentially what I'm doing is I'm including a bear market. If you think about the 2008 bear market, I'm including that in the development period so that the rules that it comes up with do not only work in a bull market. So if we had actually started the start date from 2013, then it would just become with the rules that only work in a bull market and then would probably fall apart in any sort of bear market. We want to avoid that. So only required entry condition is that the day must be an odd day. And the strategy here is set to enter on the close, which means we have to enter on the close of an odd day. I've limited it to 2 other possible entry conditions. For exit conditions, we only allow 1 exit condition, and then there's no stop loss or profit target set. You can technically mine for those as well, but I would first see if it can come up with the rules without a stop loss profit target, just because a lot of strategies, your biggest gains are going to come from holding all the way into the close. And you'll find this true for a number of things, whether it's like opening range breakout or something else. Just the better you get as a trader, the more you're like, okay, once I get really good at capturing this effect, instead of profit targeting out, you would just hold until the close for most of those strategies, especially trend following. But I don't want to dive too much into that. That's a topic for some other time. For the automatic results filtering, I want to see at least 150 trades as a back test. If it doesn't have 150 trades and we're looking at roughly a 13-year period, then I think there's not enough trades to be relevant. Minimum profit factor I set as 1.65. You kind of play around with this if you want. And then I don't want to dive into what K ratio is, but I want that to be positive. So it came up with a number of results, and I filtered out most of them using some of the robustness checks that I'm going to show in the following slides. But the result I really liked looked like this. So here, the green is the in-sample period, which is about 60% of that 13-year period. And then the blue is the out-of-sample, which is the remaining 40%. So the rules it came up with were today has to be an odd day. Again, that was the rule that we set as required. And then today's close has to be less than the 10-bar EMA. And then today has to be a Monday, Tuesday, or Friday. And then the exit condition is that today's close has to be greater than the 2-bar EMA, and that's the 2-bar EMA as of the previous day. It's not counting the 2-bar EMA as of like the current day. Like if the market was open, you wouldn't have to be constantly checking what the current 2 EMA is all the way until the market close. So hopefully that makes some kind of sense. So this is what that looks like. And now if we look at the seasonality analysis of the result, this is what we get. So obviously the strategy doesn't trade on Wednesday or Thursday. And then what I'm looking for here is really, are there certain months that the strategy does poorly in, and then see if I can glean some sort of additional rule I could add to help filter out the strategy. The mistake that you're going to make here is filtering out just 1 month. So if you look at the monthly analysis on the top right, you'll notice that October is the worst performing month. And so naturally, if you're a beginner algo trader, you may just think, oh, I'm just going to get rid of October because that's the worst month in the backtest. And depending on how beginner you are, you might also just get rid of January and February because they're red. But the problem with that is you're essentially curve fitting to the past. And what I have done is I'm looking for a rolling quarter. And by rolling quarter, I just mean a 3-month period where I can explain why I want to get rid of that 3-month period. And even though the quarters are technically January through March, April through June, July through September, and then October through December, in algo trading, you don't want to use the quarters as they're necessarily defined, but rather have a more flexible definition. So I'll give another example. If you're looking at doji effects, you could just look at doji bars on the daily chart, doji bars on the weekly chart, and doji bars on the monthly chart. But you're going to find more tradable effects if you use a more flexible definition based on what those time periods are. And so a week, rather than looking at the weekly chart to see if there's a doji, just do the past 5 days, past 5 trading days. This means that if it's like Thursday, then rather than looking at the prior week's prior weekly bar to see if that's a doji, you look at the prior 5 daily bars and then combine them and say, is that going to be a doji? And so therefore you're not limited by the weekly chart, but instead you're looking at something that makes a little bit more sense in terms of an indecision model. Just because indecision models don't specifically care about what did the weekly bar look like, but rather what have we been in an indecision period for some amount of time. So hopefully that makes sense. In this case too, we're not looking for the quarters as they are defined. We're looking for quarters as they make sense. And so the reason why I decided to filter out December, January, and February is because a lot of the holiday effects, and those of you who've watched the holiday seasonality videos in the series will be quite familiar with this. End of the year is one of the strongest holiday seasonality effects out there. And so if December is a really strong month, the Santa Claus rally, just December also is it's kind of weird because it's a month where there tends to be less volume. And so what we see here is that December is almost kind of a break-even month for the strategy. January tends to be slightly negative, but it's still also kind of break-even. And then February is considered a losing month. So my rolling quarter that I'm going to get rid of is December, January, and February. Even though that's not a quarter as you might see on the calendar, that is a quarter I can explain because of December being a generally low volume month, except for the week leading up to Christmas. And then, of course, beginning of the year holiday effects, and then possibly just to keep the concept of the quarter consistent with include February. And I would have included February even if it was a green month. Keep that in mind. I'm not going to take out July, even though that was a pretty flat month. I'm not going to take out October because even though that's the worst month in the historical backtest, because I think that's curve fitting, and I can't really explain why that month would be taken away. But I can explain why December, January, February makes sense to take away. And so those are the additional entry conditions I'm adding following the seasonality analysis. And then if we look at the robustness checks here, what we have is a Monte Carlo simulation. I'm not going to cover what Monte Carlo is. I have a prior video on that, and it's probably one of the most important videos in this series because Monte Carlo simulation is one of the most effective ways of determining your position sizing so that you can handle the sort of universe of possibilities that are likely to arise in the future concerning your strategy. So what we want to see here is that the Monte Carlo simulation has roughly an equal distribution above and below our actual backtest. Our actual backtest being that blue line that you see here. So this would simply mean that the universe of possibilities is a little bit above and a little bit below. In the most ideal case, our actual backtest would be closer to the bottom, which near the end of this, you see that it actually is closer to the bottom, which means that the universe of possibilities is likely to be better than what we see or what we saw in the historical backtest. Another parameter, or rather another condition I look for is that roughly 1/3 of the trades, once you get to the 1/3 trade mark, almost all the paths, 99% of the paths need to be profitable. So we have roughly 240 trades in this back test. So around the 80 trade mark, I'd like to see every possible path in this universe of simulations to be profitable, which they are. They're actually all profitable from the 50 trade mark, which is exactly what I want to see. And then now, if we look at the noise test, this is one of my favorite tests, and it's used to remove the vast majority of strategies that data mining comes up with. Again, data mining is really good at coming up with strategies that would have worked given the exact market values in the past. But because the market tends to be similar in the future, but not have those exact same values, a lot of strategies will fall apart. So in a noise test, what I want to see is that, again, we want our blue line to be roughly in the middle. And what the noise test does is it modifies the market data slightly. So it might change the high of a bar slightly, might change the low, might change the close. The idea is that if you change the values of the data in the past, you should have some number of results that are worse than what we got in the back test. But at the same time, you should have roughly half the results be better. And that's what you get if you have your blue line roughly in the middle of the simulations. The vast majority of strategies you'll find when data mining, though, is you'll see your blue line like way above all the simulations, and then all the simulations are just way worse than your back test. And that means that the strategy that you're looking at in data mining is not likely to work moving forward, because the moment you start messing with some of the data, all of the results degrade. And so a robust strategy is something that's able to capture an effect, even if the values of the market data were to slightly change. Um, you know, it, the idea is that in general, even if you have some degradation, the overall effect should still be present, and you should be making money. So this is a good noise test. And then if we look at the full results, this is including technically 2 out of sample periods. So if you remember, we built the strategy by data mining from 2007 to 2019. And SPY has been around since 1993. And so we have technically an out of sample period of 1993 to 2006, and then an additional out of sample period from 2020, which includes the COVID crash through present day, which would include the 2022 bear market. So this is what the results look like for this strategy. And then I placed a blue vertical line to separate the different sample periods. And so you'll see that given these rules, the early years of SPY up to 2007 would have been more or less kind of a flat strategy. But then the moment we start our development period, we start trending upward. And then after our development period, we continue to trend upward and make new equity highs. So I would consider this a strategy that is still present, and or at least it's still present, and the edges still exist following its development period. And again, I've been trading all the strategies in this series for about the past 2 years, so I can tell you that it has worked out of sample. And again, if this strategy starts to perform poorly, then what I will do is I would look at the even days effect that this is based on, and then see if that has started to degrade. And then if that has also degraded, then that's likely a sign that the strategy is getting edged out of the market. And so, again, the rules for the strategy, if you want to see them, they're over here. Today is an odd day. We're going to buy the close. Today's close has to be less than the 10-bar EMA. Today has to be a Monday, Tuesday, or Friday. And then the month cannot be December, January, or February. I know that's a lot of rules, but I can explain most of the day of the week ones. If you look at some of the earlier videos in this series, there's a video where I talked about day of the week seasonality, so I can explain the Monday, Tuesday, or Friday rules that are added, and then I just explained in this video why I'm getting rid of December, January, and February. So really, the unexplainable rules might be today is an odd day and today's close is less than the 10 EMA, but I think I could explain that rule as well. And then the exit condition is still the same. Today's close has to be greater than the 2 EMA. So that is the rules for the strategy. I think you already know enough if you've been watching this series to be able to code this in PineScript and test it yourself. Not too complicated. So definitely verify the results for yourself. But if you're going to look at other markets or even individual stocks within US equities, definitely do this odd versus even test. It's something that almost every quant does when looking at a market. Um, Again, it might seem really weird, but it's something that it is present for almost every US equity, and so it's one of the best filters if you're going to trade individual stocks in particular. Like if you're doing stock screening strategies to create like a sort of what is called a stocks in play for the day. You can then, when you're back testing that sort of stock screening trading strategy, also do an even day versus odd day analysis to even further filter out some of those trades and likely get better results. So just keep that in mind. Again, almost every quant is aware of this effect and does this sort of test. So if that is your goal, if you're watching this series and wanting to get in algo trading, then you need to be aware of it as well. As always, thank you for watching. Definitely hit the subscribe button if you've been enjoying this content. And then if you really want to take things one step further beyond just trading, then definitely take a look at the Patreon and consider joining the Discord.